Alright guys, so last week in one of my videos I did say something about the Fed having 3 more meetings this year and that they might be doing 125 basis point hikes by the end of the year, meaning that they would probably do another 250 basis point hikes and then a 25 basis point hike. But I was mistaken. The Fed only was technically supposed to have 2 more meetings this year in November and December. Oops. But my bad, I guess that's a pretty easy mistake to make. But I guess I wasn't technically wrong anyway, because over here you can see that the Fed did have a closed board meeting on October 3rd, and they weren't really supposed to be having that meeting, but a lot of people were saying that it was an emergency meeting and that they were probably having it because the global economy is starting to break. I don't think this was really an emergency meeting because they do usually have a bunch of these closed board meetings throughout the year, especially whenever they don't have an actual Fed meeting with a rate hike in the month. They usually do 8 of those meetings every year, and then for the other 4 months or so, they usually do a closed board meeting like this. As you probably heard, the British pound did collapse last week because of Liz Truss doing this chaotic and humiliating U-turn, as this says right here. They were starting to do quantitative tightening, and it broke their pension fund market, meaning that a lot of people that were starting to be retired were losing all of their money, and they had to stimulate again so that all of those people didn't lose their ability to stay retired. I have said in some of my videos in the past that it is a big problem that we have the biggest generation in all of history that is retiring right now, and that all of those people have been saving up for their whole life to retire, and if all of their money is put into pension funds and into hard assets like houses and real estate and whatnot, and with the S&P losing about 20% of its value so far this year, that means that almost a quarter of people's life savings has been wiped out. Just imagine if you worked for 60 years and you were finally able to retire, and then about 15 years worth of savings was just wiped out in a couple of months. That would be absolutely devastating, and you would definitely need someone to help you out. That's why the Fed cannot continue to do this quantitative tightening and continue raising these rates, because something like what happened over in the UK can happen over here, and they are going to have to stimulate if those pension funds and retirees see all of their funds wiped out. As this article by CNBC says, surging volatility in what are supposed to be among the safest fixed income instruments in the world could disrupt the financial system's plumbing, according to Mark Connors, former Credit Suisse global head of risk advisory. That could force the Fed to prop up the treasury market, he said. Doing so will likely force the Fed to put a halt onto its quantitative tightening program ahead of schedule. That's another thing that I have been talking about in recent videos, is that if the Fed does continue to raise rates, then all of the dollar-denominated debt around the world is going to be a lot harder to service, and that's going to make people and countries start to default on their debts, and that's going to disincentivize people from investing in US dollar-denominated debt, hurting our place as the global reserve currency. All of this is absolutely unacceptable for the Fed to be doing, and I'm sure that they know that this is what's going to be happening. They just have to sound very hawkish at this time, because what they're saying is driving the actual actions that's happening in the market, and it's what's been pushing things down ahead of their actual actions. So if they continue to act hawkish, then they might not actually have to do the rate hikes that they've been saying that they're going to do, because the markets will move preemptively to take up that slack in the economy like the Fed just wants to do anyway. According to this article on Investopedia, pension funds typically keep most of their assets in fixed income investments like US Treasury securities, private equity, and real estate. And if the Fed is trying to crash real estate prices and crash the stock market, then you already know that all of these retirees are going to be totally devastated, and the Fed is going to have to do more quantitative easing eventually anyway. I believe that in their so-called emergency meeting held on October 3rd, they probably talked about how they're probably going to be slowing down or possibly even pausing their rate hikes in the next meeting. This is just speculation by me, but as you know, in their last meeting they did say that they want to see, and they've been saying in a lot of their previous meetings, that they want to see inflation coming down and sure signs that it's going to be headed back down to 2%. Right here we have the 5-year break even, and this is the future inflation expectations. As you can see, it has come back down to about 2.26%, and that's just 0.26% higher than what the Fed wants inflation to be at in about the next couple years. The Fed didn't say that they have to see inflation back down at 2%. They said that they want to see a strong indication that it is headed back in that direction. And we are seeing these indications starting to show, like this 5-year breaking even, being back down at about 2%. Here we have the University of Michigan's Consumer Sentiment Survey. And as you can see, recently we have been having the consumer sentiment lower than any time since the survey began. And that means that it's even lower than 2020, whenever everybody thought that at least 1 out of 5 people that they knew was going to be dying and the world was going to be ending. It's even lower than it was in the 2008 financial crisis, and even back in the 80s whenever they had all of that crazy Paul Volcker situation and the inflation runaway that everybody's been comparing this current time to. Also, as you can see, whenever this sentiment has bottomed out, it's usually at the recession level. They just haven't finally announced that we are in a recession yet. But as I've said, and we finally did get the 3rd consecutive negative quarter of GDP in a row, we have been in a recession since the beginning of the year. Another indication that inflation is going to be headed down is that we got the job openings and labor turnover summary, or JOLTS, and the number of job openings decreased to 10.1 million, which is 1.1 million less than last month and a little bit lower than expected. Right here we have a chart indicating all of the job openings, hires, and separation rates seasonally adjusted, with this solid red line right here being all of the non-farm payroll job openings, and it did start to finally dip here in the past month. That means that the job availability is starting to come down, and that is something that the Fed has been looking forward to. Also, as you might not be able to tell, but the non-farm hires has also gone down, and the non-farm separations has slightly ticked up, meaning that people have started to separate from their non-farm jobs. Later on this week, we have initial jobless claims, which is going to be really important to see if the unemployment rate is starting to tick up. And we have non-farm payrolls and the unemployment rate coming out on Friday, which is also going to be really important to indicate whether these job openings are starting to come down and if the unemployment rate is starting to go up, which is something that the Fed has said that they're starting to look forward to, so that they can see that inflation is coming down and they can start to pause on their interest rate hikes. If all of this information isn't enough to show you that inflation is starting to peak and the Fed is going to have to definitely slow down, at least with their interest rate hikes, and possibly even go back to quantitative easing pretty soon, then really just the sentiment being so negative should be enough to tell you, because in my opinion, a contrarian strategy is going to probably beat 90% of the market, because as they say, 95% of people cannot beat the market because of emotions getting in their way. Buy whenever there's blood in the streets and be greedy when people are fearful. That's what all of the sayings point to, and right now that's what we're seeing. So like I said, if all of this data isn't enough to show you that the Fed is going to have to start slowing down their interest rate hikes soon, and we're probably going to be headed back to the upside, then taking a contrarian view should probably make up your mind for you. This week we have earnings for a bunch of banks coming in, and I think you're going to see that these interest rate hikes are having a really detrimental impact on our banking system, and we are possibly even in danger of another Lehman-style global financial crisis because of things like Credit Suisse and the Deutsche Bank starting to collapse overseas. For this reason, I'm sticking to my guns, and I still believe that Bitcoin has probably reached its low at about $17,500, and it probably won't be headed any lower from there in my opinion. I could definitely be wrong, and the stock market could definitely have another leg lower because earnings are going to probably be coming in negative or a lot lower than people are expecting, and that is possibly going to be having another leg lower for the stock market that has still yet to be priced in. However, cryptocurrency does not have earnings, and it doesn't have employees that have to be let go. So I think that hopefully, if it really does succeed in doing what Satoshi Nakamoto built it for in the first place, then we will be seeing a decoupling from the stock market here whenever the Fed does hopefully pivot and while earnings continue to decline. And cryptocurrency will possibly start to recover, or at least will be probably spared, in my opinion, from the next leg down with the stock market. Let me know what you guys think is going to be happening, if the Fed is going to be pivoting, or if the crypto market is going to be getting crushed along with the stock market whenever earnings come in disappointingly. Thank you guys so much for watching. I hope you have a wonderful day, and I'll see you guys next time. Bye.